Right now, you can lock in a guaranteed risk-free return of roughly 4.5% on U.S. Treasuries.
Yeah, which is a pretty solid yield.
It really is. Yet institutional and retail investors alike are just currently throwing trillions of dollars into a stock market that, structurally speaking, guarantees they're probably going to underperform those same government bonds over the next decade.
Right.
So why is Wall Street voluntarily jumping into what looks like a financial black hole?
Well, I mean, it comes down to this really historic disconnect between the underlying economic architecture and, this narrative of perpetual growth.
Yeah.
We're basically witnessing an environment where asset prices have completely severed ties with the fundamental constraints of capital.
And exploring that massive disconnect is really our mission for this deep dive.
Exactly.
We're going to figure out exactly what you, the listener, can expect from the stock market and the broader economy between now and 2036.
Right, the next 10 years.
Yep. And to do that, we are tearing into an exhaustive stack of June 2026 reports. They're synthesized under this title, Market Indicators and Decade Outlook.
It's a massive stack of data.
Oh, it's huge. We're looking at proprietary data models from Goldman Sachs, Vanguard, the Federal Reserve's updated projections, and, historical valuation metrics tracking back over a century.
And the cross-currents in these reports are just fascinating.
They really are.
I mean, you have this extreme localized optimism colliding head-on with a rapidly tightening global liquidity environment.
Okay, let's unpack this. Because to understand where equities are heading, we first have to look at the bedrock of the financial system.
Right, the macro environment.
Exactly. We need to look at the cost of money. For the last 10 years, zero interest rate policy functioned like a helium balloon for asset prices.
Yeah, just pulling everything up.
But the climate has radically shifted. And the May 2026 inflation data threw a massive wrench into the market's expectation of, a return to easy money.
It really did. The May inflation print unexpectedly accelerated to 4.2%.
Wow.
Yeah, that is the highest level we've seen since April 2023. And this wasn't just some statistical anomaly or a base effect glitch either.
Right. It was real structural stuff.
Exactly. It was driven by tangible energy supply shocks and a labor market that just continues to run incredibly hot.
Because the consensus narrative coming into the year was that inflation was on this smooth, uninterrupted glide path back down to the Fed's 2% target, right?
Yeah, everybody thought we were cruising back to 2%, but that 4.2% print completely shattered that assumption.
And you could really see the fallout from that shattered assumption at the June 2026 FOMC meeting.
Oh, absolutely.
New Fed Chair Kevin Warsh and the committee, they voted unanimously 12-0 to hold rates at 3.50% to 3.75%.
Which was expected, but still a big deal.
Yeah, but it's not just the pause that grabbed my attention. It's the updated summary of economic projections.
The dot plot.
Yes, the dot plot. It demonstrably shifted higher. The median expectation now projects a 3.80% rate by the end of 2026.
Which is a huge shift in expectations.
Definitely. I mean, 9 officials forecasted at least 1 hike, and 6 anticipate 2 or more. That is a hard, formalized, hawkish pivot.
If we connect this to the bigger picture, the Federal Reserve is signaling that the era of using monetary policy to basically backstop equity markets is over.
They're done playing savior to the stock market.
Right. They are prioritizing inflation containment over asset price inflation.
Yeah.
And the immediate consequence of that policy stance is reflected directly in the 10-year U.S. Treasury yield, which, like you said, is now sitting at a formidable 4.55%.
So what does this all mean for the present value of future corporate cash flows?
It changes the math completely.
I mean, if I'm an investor, I suddenly have a formidable low-risk alternative. I don't have to take on the wild volatility of the S&P 500 to generate yield anymore.
Exactly. That 4.55% risk-free rate structurally lowers the present value of all long-duration assets.
Because the discount rate is higher.
Right. The equity risk premium, which is the excess return investors demand to compensate for the inherent danger of owning stocks, is severely compressed right now.
It's basically non-existent.
Yeah. For the first time in well over a decade, fixed income instruments are competing directly with equities for capital flows.
Meaning money actually has a place to go that isn't the stock market.
Precisely. If you are applying a higher discount rate to future earnings, the current price you are willing to pay for those earnings must mathematically drop.
Which brings us to the ultimate paradox of these reports.
The valuation disconnect.
Exactly. The cost of capital is elevated, the discount rate is way up, but the market hasn't corrected.
Not at all.
In fact, valuations are hovering in the stratosphere.
Yeah.
Let's look at the aggregate metrics, starting with the Buffett Indicator.
Oh, this one is wild.
It really is. When you measure the total value of the U.S. stock market against annualized U.S. gross domestic product, The numbers are just jarring.
Very.
The total market value is estimated at around, what, $69.15 trillion?
Yeah, just over 69 trillion.
Right. While annualized GDP is sitting between 31.57 and 31.81 trillion.
So that pushes the Buffett indicator to a staggering 214% to roughly 234%.
Wow.
Yeah. To contextualize that, the historical long-term average is roughly 111% to 135%.
So we are way, way above normal.
We are looking at a 2.1 standard deviation anomaly. A ratio this skewed basically suggests that market participants are pricing in a rate of future corporate growth that far outpaces the actual economic output of the entire country.
And the Shiller-KP ratio confirms the exact same distortion, doesn't it?
It does. It lines up perfectly with the Buffett indicator.
Because in June 2026, the S&P 500's APE ratio sits between 39.9x and 41.5x.
Which is astronomical.
Right. We know the historical average over the last century and a half is about 16x to 17x.
Yeah, 16 to 17 is normal.
In 155 years of financial history, the only other time the S&P crossed that 40x threshold was in March 2000.
Right at the peak of the dot-com bubble.
And we all know how that ended.
The historical parallel is profound. Buying the aggregate index when it resides in the top valuation decile, let alone pushing past 40x, has historically locked investors into a decade of real returns hovering around zero.
Basically a lost decade.
Exactly. The multiples simply have too far to fall to revert to the mean.
I have to push back on that, though.
Okay, let's hear it.
Because here's where it gets really interesting. Bulls argue we are operating under an entirely new paradigm.
They always do.
Right. But critics of these historical metrics point to the permanent productivity gains driven by artificial intelligence.
Sure, the AI supercycle narrative.
Yeah, and they point to asset-light tech monopolies that scale globally without needing, new factories or physical infrastructure.
Right.
And we can't ignore the fact that corporate profit margins fundamentally shifted upward following the corporate tax rate cuts during the Trump administration.
That is a factual piece of the puzzle, yes.
So, haven't those structural changes permanently elevated the baseline for valuations? I mean, why should we expect a reversion to a 16x AKD when the modern corporation is so much more efficient?
Well, the new paradigm argument always surfaces at the peak of business cycles. It's a compelling narrative, I'll give you that.
It sounds good on paper.
It does, but it requires you to assume that current peak profit margins are a permanent plateau rather than a cyclical high.
Ah, I see.
Rigorous macroeconomic analysis shows those margins are actually incredibly fragile. They are about to face severe compression from two distinct, unavoidable headwinds.
So the tax cuts and tech efficiency are already priced in, basically.
Exactly. You cannot extrapolate recent tax advantages or tech efficiency narratives indefinitely while ignoring the brutal realities of operational friction and debt structures.
Okay, let's dive into those two hidden headwinds then, because the Goldman and Vanguard reports heavily emphasize this.
They do. It's a huge part of their outlook.
The first one is what they refer to as the debt cliff.
Right. So during the low interest rate environment of 2020 and 2021, corporations acted completely rationally.
They loaded up on cheap debt.
Exactly. They insulated their balance sheets by issuing massive amounts of long-term corporate debt at historically low yields.
Because money was essentially free.
But that debt was not perpetual. We are now entering the window in 2026 and stretching into the late 2020s where trillions of dollars of that low-yielding debt is maturing.
It's exactly like an adjustable rate mortgage resetting on a massive, expensive property.
That's a perfect analogy.
I mean, if you bought a home when mortgage rates were 2%, your monthly payment was super manageable. You felt rich.
Right. You had extra free cash flow to spend.
Exactly. But the moment that fixed period ends and your rate adjusts to the current 5% or 6%, your interest expense suddenly devours your entire paycheck.
And that refinancing cycle is already locked into corporate maturity schedules. Companies must refinance that debt at the new elevated rates dictated by that 4.55% Treasury yield.
Which hurts the bottom line.
Brutally. That means a massive structural increase in interest expense that will siphon capital directly out of net earnings.
Wow.
What's fascinating here is that investors are completely ignoring this. It will systematically compress profit margins regardless of how efficient a company's software is.
And the second headwind might be even harder to navigate because it targets gross margins before we even get to the interest expense.
It's the supply chain issue.
Yeah, the reports highlight the fracturing of the globalization supercycle. We are seeing a massive shift from optimized just-in-time supply chains to just-in-case inventory management.
This is a fundamental reversal of a 40-year trend.
Right.
For decades, companies squeezed every conceivable ounce of margin out of international labor arbitrage and perfectly timed global shipping.
But the geopolitical landscape has changed.
Dramatically. Geopolitical tensions, tariff escalations, and regional supply chain vulnerabilities have forced a systemic change in how companies operate.
They are basically being forced to hoard inventory. Because if you can't rely on a microchip arriving from overseas the exact day you need it for the assembly line, you have to buy a 6-month supply and stick it in a warehouse somewhere.
And warehousing costs money.
Ensuring that inventory costs money, too.
Right. And holding raw materials ties up billions in working capital that could otherwise be deployed for growth or dividends.
So it's a huge drag on capital.
It is. A regression analysis of corporate balance sheets reveals a highly statistically significant inverse relationship here between inventory bloat and profitability.
Which means?
If the aggregate inventory to sales ratio simply reverts to its historical average of 1.4, which is actually a conservative expectation given current deglobalization trends, the resulting operational friction alone is enough to force corporate EBITDA margins back down to their historical average of 19%.
Wow. So if margins are inevitably compressing due to the debt cliff and deglobalization, and valuations are sitting at 155-year extremes, why isn't Wall Street panicking? I mean, when we look at the psychological side of these reports, the data implies an imminent crash. But the VIX, the volatility index, is sitting at a sleepy 17.45.
It's surprisingly low.
Right. It's implying options traders only expect the S&P 500 to move about 1% a day.
Right.
Why is there such a massive disconnect between the fundamental data and institutional behavior?
Well, the VIX at 17.45 is creating a dangerous illusion of safety.
An illusion.
Yes, that calmness is entirely artificial. It's not a reflection of genuine market stability or a lack of institutional concern.
Then what is it?
It is the mechanical result of massive, systematic short volatility strategies.
Explain how that works, because I think a lot of people just assume a low VIX means everyone is relaxed and happy. How do these strategies actually suppress the volatility index?
Okay, so the market is currently saturated with yield-enhancing derivative funds.
Right.
These funds systematically sell call and put options on the major indices to generate premium income for their investors.
They're harvesting yield.
Exactly. When you have billions of dollars programmatically supplying options to the market every single day, it structurally compresses implied volatility.
I see.
The open interest on the options chain is exceptionally high, and it creates a localized anchoring effect, particularly around the mega cap tech stocks.
So they're pinning the market in place.
Yes. Institutions are effectively selling volatility to harvest yield, and that relentless selling pressure forces the headline VIX downward.
It's like a commercial flight where the pilots, the institutional algorithms, are fast asleep at the wheel while the passengers in economy, the retail investors, are wide awake, clutching their life vests and staring out the window at the burning engines.
That is a painfully accurate analogy.
Because the AIII Sentiment Survey, that's the American Association of Individual Investors, shows that retail investors aren't buying the illusion of safety at all.
No, they see the writing on the wall.
They see the data, and they are terrified. Bearish sentiment in the retail sector just surged to 47.7%, which is massive.
It is.
The bull-bear spread plummeted to negative 17.3%.
The divergence between institutional complacency and retail sentiment right now is one of the most severe on record.
And it's especially focused on tech, right?
Oh, absolutely. When surveyed specifically about the technology sector, the retail fear of an asset bubble is palpable.
The AI bubble.
Yeah. 36.3% definitively stated there is a bubble in AI stocks, and another 51.5% believe AI stocks are simply too expensively valued right now.
So almost 90% of retail investors are looking at the market leaders with extreme caution.
Yes.
The contrast is just wild. You have institutional algorithms mechanically suppressing volatility, behaving like everything is perfectly fine, while retail investors are actively bracing for impact.
And this raises an important question regarding how we define risk and the consequences of that artificial calm.
How so?
Historically, when you have suppressed volatility coinciding with peak market valuations, it acts as a tightly coiled spring.
Ready to snap.
Exactly. The lack of day-to-day volatility encourages aggressive deployment of leverage by risk parity funds and institutional trend followers.
Because it looks safe on paper.
Right. But when a catalyst finally hits that forces volatility to spike, those same funds are mechanically forced to deleverage simultaneously.
Causing a cascade.
Yes. It establishes the exact preconditions required for a rapid, non-linear market correction.
So the spring is coiled, the fundamentals are deteriorating, the valuations are stretched.
The perfect storm.
Which brings us to the ultimate question for you listening. What do the smartest institutional minds predict for the 2026 to 2036 decade? And, how should you position a portfolio to survive it? Let's look at the 10-year capital market assumptions.
The overwhelming consensus among the major institutional asset managers points to a severe reversion to the mean.
They're expecting a drop.
Yes. Goldman Sachs ran a really robust regression model. They incorporated current valuations, market concentration, historical economic contraction frequencies, and the elevated interest rate environment.
And what did they find?
Their conclusion: they project the S&P 500 will deliver an annualized nominal total return of just 3% over the next 10 years.
3% nominal. Which means, once you factor in inflation, the real return over the next decade is roughly 1%.
Practically nothing.
Goldman is literally stating there is a 72% probability that U.S. equities will underperform risk-free government bonds over a 10-year horizon.
That's a huge red flag.
And Vanguard's proprietary modeling engine isn't much more optimistic either. They are projecting a meager 3.9% to 5.9% annualized return.
It is worth noting, though, there is a bullish outlier in the reports.
Oh, right, Yardeni.
Yes, Yardeni Research. They are forecasting an 11% annualized return, projecting the S&P 500 will hit 10,000 by 2029.
But what are they basing that on?
Their thesis relies entirely on an AI supercycle delivering unprecedented exponential productivity gains across the entire economy.
So they're assuming no mean reversion at all.
Right, effectively validating the 40x multiples as the new normal.
Why should you care about this 3% consensus versus the 11% outlier? Well, because if you are relying on the lazy, set it and forget it passive index investing strategy that worked so beautifully in the 2010s, you're exposing yourself to massive structural vulnerability.
You really are.
Think about sequence of returns risk. If you are retiring now and drawing down a portfolio at a 4% or 5% withdrawal rate, but the aggregate market is only generating 1% real returns from a 41.5x KP peak, your portfolio has a statistically high probability of catastrophic failure.
And furthermore, capital allocation at the corporate level becomes highly destructive at these valuations.
The buybacks.
Yes, the stock buybacks. Companies that are aggressively buying back their own stock right now at 40x earnings are actively destroying shareholder value.
Wait, how does that work mathematically?
Well, when you buy back stock at 40 times earnings, you are deploying corporate capital for an implied earnings yield of just 2.5%.
Oh, I see.
Why would a management team lock up capital at 2.5% when they could simply hold risk-free government bonds at 4.55%?
That makes no sense.
It doesn't. It represents an incredibly inefficient allocation of capital that will ultimately drag down the broader index returns.
So how do the institutional models suggest pivoting? According to the framework laid out by Capital Group and Makita, the most immediate shift is moving away from U.S. capitalization-weighted indexes.
Which have dominated for so long.
Right. Because market concentration is currently at a 100-year high, driven by a handful of mega-cap tech stocks. Equal weight indexes offer a massive structural advantage and are projected to heavily outperform over the next decade.
And geographically, the models indicate the real value has shifted entirely overseas.
To international markets.
Exactly. While the U.S. trades at a SPI over 40x, international developed markets and emerging markets are trading at severe relative discounts.
They're much cheaper.
Yeah, sitting much closer to or even below their historical averages. The Capital Group models project emerging markets returning 6.5% to 6.8% annualized.
And there's a hidden catalyst for emerging markets embedded in these reports, too.
The currency aspect.
Yes. Vanguard's decade model projects a U.S. dollar depreciation of negative 0.5% annualized.
Which is significant over 10 years.
It really is. If the U.S. dollar slowly weakens over the next 10 years, it removes a massive historical headwind for emerging market economies, particularly those carrying dollar-denominated debt.
Right, their debt becomes cheaper to service.
Exactly. It allows those heavily discounted valuations overseas to compound significantly faster.
Which leaves us with a final thought to consider, really building on everything we've analyzed across these reports.
Let's hear it.
If the next decade truly sees the U.S. dollar slowly depreciate, while the broadly weighted U.S. equity market stagnates due to margin compression and high starting valuations, the real danger to your portfolio isn't necessarily a dramatic, cinematic stock market crash that dominates the headlines.
No, the real danger is much quieter.
The real danger is the silent, invisible evaporation of purchasing power over a decade.
Inflation eating away at the core.
Exactly. You could look at your brokerage account in 2036 and the nominal dollar figure might look perfectly fine. But what that money can actually buy in the real economy will have been decimated by the compounding effects of persistent inflation and near zero real returns.
That is scary.
It is. The ultimate contrarian play for the next 10 years might not just be rotating into emerging markets or equal weight indices. It might require fundamentally redefining what a safe asset even means in a deglobalizing world where the foundational cost of capital has permanently shifted.
That is a profoundly sobering thought to leave on. You have to ensure your portfolio's engine is tuned for the gravity of the current decade, not the last one. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
Sounds good.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment financial decisions. Don't forget to like this video. Much appreciated.